Hey everybody, it's John Parisi. Today is Friday, September 22nd, 2023. The market closed a little while ago. We were off again, wrapping up a negative week for the market. So far, pretty negative September. No surprises here. Anyone watching our videos know we have kind of been expecting this. Big news this week is the Fed meeting on Wednesday. Powell came out saying they're leaving rates unchanged, but he left the door open to further rate hikes if the economy stays heated and inflation doesn't simmer down. So the market didn't like that. Treasury yields went up, and those higher Treasury yields, 15-year highs. The 10-year note touched 4.45%. 2-year note touched 5.2%. Market found some headwinds in those and have been trading off. That being said, right down here, we're going to start trading changing our trading posture moving forward. And there's a lot of other headwinds. These interest rate hikes are starting to bite into real consumers' pocketbooks. Credit card debt, which last month exceeded $1 trillion again for the first time since COVID, meaning people have gone through all of their COVID savings from not going out, not traveling. They've spent any stimulus savings they've done, and now they're going into carrying balances to meet their lifestyle on a credit card. Those rates have now in the last year moved from 16% on average across the country in a credit card to now 21%. So, you really can't spend as much money. On top of credit cards, you have 30-year mortgages have gone from 4.29% a year ago up to 7.29 this week for a 30-year fixed mortgage. Auto loans, 9.2 a year ago up to 11.2%. So home equity lines have jumped up too. So borrowing money to purchase things has just gotten really tricky in here. And these are basic everyday things, your home, your auto. Now you've got oil prices spiking up above $90 a barrel. And smart money talking about it exceeding $100 a barrel. That is going to continue to creep into gas prices, which is a direct tax on the American consumer. Every time you go to the pump, it's back to school. So, parents are taking their kids to and from school. They're taking themselves to and from work, running errands, trips on the weekends. There is less money in your pocket at the end of the month. And on top of all of this, you've got the Hollywood writer strike, which apparently is making some progress, but they haven't settled yet. You've got the auto worker strike in Detroit. And now you've got this looming government shutdown in October, and all the fireworks and media storm is going to start with that in the next couple of days, couple of business days. So there's a lot of short-term headwinds to the economy, and we saw that in the market this week. I'm going to share my screen here. We're going to go to our chart that we like to pull up. And I made an annotation in here. As I said, we're going to change our trading posture from a hold back to a buy. Let's just get up to speed here. Back on September 1st, we went to a hold. The market had become overbought into that rally off the August 18th low. We did a video on both of those dates indicating those changes in our posture. On August 18th, the market had just become too oversold, too negative. The indicators that we follow had become oversold, giving us the confidence to step into the market. Again, we advise going slow because you never know how this is going to work out. These indicators are reliable, but they're nowhere near a guarantee. On September 1st, we went to a pause, and it just means we're putting our pencils down. We're not doing any more work in terms of entry points, and we're going to be cautious in here. And we did some tax selling up there to harvest some losses for clients. We traded down throughout September as we expected, and just before the market closed, I put a new green arrow in there on 9/22/23, and I changed the short-term indicator up at the top of the screen to a buy. It doesn't mean buy, go out and buy now. What this means is that the market is incredibly oversold right now, very oversold. In fact, some of the lowest readings I've seen in a long time. But the market can do one of three things from here. We can either just roll over and keep going down. And we've seen that happen. That happened during COVID. We were probably a month early there, and we bought throughout that dip. It could do that. Very often it'll catch a bounce for 2 or 3 or 4 days and then resume the downtrend. And then, ideally, it'll begin to track higher, catch a bid, stabilize, and start to advance from here. So we really don't know what we're going to get. What we are saying in here is this is not a bad entry point. This is everything is so oversold. The selling pressure has exhausted itself, at least in the short term or in the next few days, worst case. And it's probably not a bad time to dip your toe in the water in terms of putting some risk on in your portfolio. So adding to stocks in this case. And we'll be doing a little bit of that. We are mostly fully invested right now, which we did way back in the spring. And this has turned out to be a pretty good year. This pullback as well, even with this pullback. So that's kind of where we are. We'll have to kind of keep an update on what's going on. And, we're going to determine as the market moves on how we're posturing into year end. We are in the middle of tax selling season. So we have been harvesting losses for clients, especially in fixed income, which is down again, just due to the Fed rate hikes. We're taking a lot of that money and we're rolling it into treasuries that mature in December. There's zero matures in December 26th and one in December 28th. You'll begin to see those in your portfolio. We bought 25 million today. We'll be buying more next week. We bought a bunch last week. And what we want to do is we want all that capital coming due at the end of the year, because we're going to do another major rebalance in our portfolios come the first of the year, or the first trading day of the year, the first trading week. But we are going to be generating some capital gains. We want to throw those into 2024. As far as our outlook, we are in the weak part of the season. We said that in the last video. Go watch it. We showed a screen that September and August are historically, all the way back to the 20s, the two weakest performing months of the year. So no surprises there. This is very normal corrective behavior. Until this week, it actually was a really orderly correction. The latter part of this week was a little sloppy. So, but again, we're getting some really oversold readings in here. And what that just simply means is it's going to take more selling pressure, more dollars into the market to push it even lower, and less in coming in to buy it. So we'll see if that holds. That is really it. We've got one more week in September, and then we head into October, a very historically volatile month. Remember, last year, the market bottomed on October 13th. If you look at our chart, you'll see that we were in buying that day. So we still have that wood to chop in terms of seasonality. And then we're going to finish into the three of the next strongest months, which is November, December, and January. So we are looking for a stronger market as we head into the last few months of the year. But anything can and will happen. And, our job is just to kind of stay the course and make sure we're managing risk appropriately. But we are looking to get back up to that 4,600 level on the S&P 500. We're at 4,320 today on the close. Let's see what happens. So on that note, we'll continue to do these videos. We'll be getting good feedback. If you have any questions, call or email me or anyone on the team here. And we'll look forward to talking to you next week. Have a great weekend, everyone. Bye.